The following is paid programming.
I'm a big fan of money. I like it. I use it. I have a little.
You want something more.
I keep it in a jar on top of my refrigerator.
Something more from your hard work.
I'd like to put more in that jar. That's where you come in.
It's gotta be something more. Gotta be more than this.
Whether it's financial planning, mortgages, insurance concerns, or those quality of life issues that make the money matters matter. Whatever is on your mind today, call Something More now, toll free, 866-771-8901. Come on, let's get you something more.
I still can't even hardly believe my ears when you even tell me this.
Gotta be something more.
Something More with Chris Boyd, certified financial planner professional, advising clients across the country. Here he is, J. Christopher Boyd.
Welcome back to Something More with Chris Boyd. Thanks for being with us throughout the show. We've got Kathy Ingersoll and Jeff Perry, our two co-hosts, I guess, this week. Kathy, you're gonna stick around. We're gonna keep you in the mix. So, thanks for being back with us this week. We are talking to everyone about a variety of things, and we'll be talking a little bit about portfolio composition, some thoughts around bonds and international stocks, as well as some of the other things we've been talking about. There's lots of considerations for us to discuss. To kick things off, I happened across an article, and I saved it, and now I don't have it at my fingertips, so I apologize for that, guys. But the headline caught my eye, and it was out of Market Watch, and the essence of it was, my husband thinks financial advisors are worthless, and the wife is thinking they need some help in this scenario, and what should she do, kind of thing. But I thought the whole idea of is there value in having a financial advisor is probably something that a lot of people give thought to at times to consider. Is it worth it? I mean, there's a cost. There's a cost. And I'm sure our listeners get tired of me mentioning some of the things that we've talked about, which include the Vanguard study that tried to, they say, quantify advisor alpha is the way they put it. But basically, is there a monetary benefit to having a financial advisor? And they estimate on average over time that can be as much as 3% per year because of a variety of factors when it comes to the big one being behavioral coaching. People want to make the wrong move at the wrong time.
And they usually do. If the herd mentality is usually going the wrong way. We
are very often drawn to want to sell low and buy high, right? When things are going great,
super high, I want to get in.
I got to get more.
Crashing, I want to get out.
Right, exactly. Exactly. And so having some help in that process, part of that is maybe identifying the right asset allocation and rebalancing to that from time to time, paying attention to the costs of the investments we utilize. There can be all kinds of decisions about where investments should be placed and a variety of other things that they point to. Scott Birmingham, our lead financial planner, routinely talks about other aspects of the financial planning that add value. We were talking about whether to do a Roth conversion in a prior segment of the show. That can be a hugely financial impactful decision. When should I turn on my Social Security?
Big one.
Huge
Very important.
consequence. Because people think, well, I retire, I immediately turn on all these tools, resources. But you don't necessarily have to do them simultaneously to figure out what's going to get you the best outcome.
They don't stand alone, right? They're
That's right.
pieces of a puzzle that go together.
That's a great point. So there's all these different considerations. Brian likes to talk about the Dalbar study. The Dalbar study that says most investors in funds tend to get a return that's markedly less, and it's high percentages, 5% or something, less than the fund that they invest in. So it's
based on emotional decisions usually.
Yeah.
Chris, people can do it themselves, right?
Well, there are times when people can, as we said.
I could fix my own car too, but I don't do that because you know what? My mechanic, in fact, my car's in the garage today. My mechanic fixes hundreds of cars a year, and he's trained to do that, and he's an expert at it, and that's why I rely on him to do his job. He makes my life easier, and I trust him.
You look to professionals to get a better outcome, right? When it comes to your legal work, you could get it out of a box.
That's a great analogy, Chris. As a lawyer, I'm disclosure here. I mean, you can get forms out of a box and fill them out, and you know what? It might be all right.
It might be, but
it might be catastrophically bad.
Exactly. And so, it's not to say that it couldn't be a cheaper way to do it, but sometimes you get what you pay for, right? And you can end up with a lot of missed opportunities and problems. When it comes to a physician as well.
I was going to say, you meet with hundreds of clients a year, and someone may come in with a situation that is a new situation to them, right? They've never experienced this. They don't know how to address it, or they're looking for a little guidance. The benefit, I think one of the benefits in working with a financial planner is they've done this. They recognize the situation, and they have the experience in dealing with all of these clients.
And tools.
Yes, and tools.
That's the combination. I often refer to a story when my friend came over to help me. We were going to put some plywood down in my attic. And I bought
Sounds simple.
I bought some plywood. And so...
Good start.
So he came over. He goes, well, gee, that's not going to fit through the attic space.
The whole.
Maybe we should saw that into smaller pieces. Okay. He's like, do you have a saw? I was like, yeah, I got a saw. Doing. I got the old. So I was ready to get out the saw. He's like, oh no. I got my skill saw in the truck. Hang on a second. He comes out, pulls out this piece of string. Thwop. He throws some line on the chalk on the thing, and it's done in 5 seconds, right? So then he goes, all right, let's get it up there. So we get it up there, and he's like, what were you thinking? How do we want to fasten it to the floor? I was like, I got some nails, got a hammer, He's like, we won't do that. I got a bunch of screws. Brings out this bucket of screws in a big old coffee container, a can, and he's got the power equipment. We're like, in about half an hour, we got this thing done. Would it take? I'd still be doing it 3 years later.
You'd still be sawing crookedly.
Exactly. You know what I mean? Having the right. I just think that's such a great illustration of the right tools. Right in the kitchen, you have the right tools. It can make a huge difference on how your baking, your cooking, whatever it may be, can turn out. So having the experience you were talking about, having the right tools. I mean, you're right. It's after a certain number of years, it's unusual that you find a circumstance that's not familiar. You know what I mean? So it's not to say that every aspect is the same, but you've got these recurring themes and recurring considerations that, you kind of get a handle on how to think about.
One thing that I think people who are looking for a financial advisor sometimes run into, especially if they're not very experienced, is they may the term financial advisor is pretty broadly used.
It is, yes. That's a really good point too.
And so they may hear about or know someone who just got their license and they're working for a insurance company or something, or they may have someone that works for a company that sells one product, or maybe they just push people towards annuities, or all these things that have places in a financial plan if it's right. But sometimes in the term financial advisor, you end up with someone who doesn't have a lot of tools. They may have one thing that they use. I have a friend who's a surgeon, and he says, if a doctor refers someone to me, they're having surgery, right? So if you go to someone whose primary job is to sell life insurance or sell annuities or whatever it is,
you look like someone who needs an annuity or a life insurance policy.
If you go to someone selling life insurance and say, I need to save for my child's college, they're going to come up with a life insurance policy that you can save for your child's college, which definitely isn't the best option.
Well, it's certainly got some costs built into it, and it's hard to get that money out. You know what I mean? So.
There's
You always defend that when I say that, so I
Oh,
appreciate that.
I just, I mean, my point is, look, I wouldn't do it, but I don't want to say it's never the right thing to do either, right?
All right,
Yeah.
it's almost never the right thing.
Yeah, exactly.
So you have to know where you're going. So back to that earlier conversation, if you missed it in hour one about a fiduciary, it may not be asset management resources. We might not be the perfect company for everyone.
Right.
But if you're working with someone and you just ask them a couple of questions to start out with, are you a fiduciary? That means they have to take your best interest at heart when they're giving advice or selling you products. And number two is ask them, how are they getting paid? And if they can't give you a yes on number one and a real simple answer for you to understand on number two, you should probably look somewhere else.
another point that I was going to bring up, Jeff, is if you're managing it yourself or you're using another advisor, how active are they in managing your portfolio to ensure that it continues to be diversified based on,
Very good point,
all the changes that are happening geopolitically, your personal goals. I remember, Chris, before I ever started working with a financial planner, I worked at a large global bank for many, many years. I had restricted stock, I had a brokerage account, I had individual stock, and then I was investing in these mutual funds. Well, you know what? Lo and behold, like 20% of the mutual fund was this bank that I worked for. So
You
when
were
you
loaded
dig into
with
the
exposed,
weeds, when you dig
Yeah.
into the weeds, you really find out maybe I wasn't as diversified as I thought I was.
That happens a lot, Kathy, that people
I didn't
think
have the
they're
time.
diversified or they're drawn to the same kinds of investments, this fund, that fund, the other fund. It turns out they're all very
A
similar
large
in
cap
nature.
or whatever, right? They're all the
Yeah.
same goal.
Or
right?
maybe someone has a business experience in technology, so they are drawn to technology stocks, or you were talking about financials or whatever it might be. And oftentimes we run into people who have an abundance of a single position that has been great to them over time, and they've made money, but as a consequence, they have exorbitant amount of risk that was unexpected. And so, there are techniques that we can try to help to say, how do we mitigate some of that risk? There are some tough questions about, are you willing to pay taxes? Does it make sense to pay taxes? You got to think through some of these things, but there may be techniques to help mitigate some of that risk in the meantime.
Right.
And
Right.
just
All
the
good points.
research takes a lot of time to do that amount of research, right? You've got to have access to the information and the time to decipher what it all means.
There's a whole nother side of this, which I'd like to go off on a tangent, which
Go ahead.
maybe I have time, maybe I don't. But we're talking about returns and diversification and investments and fiduciary responsibilities, and those are all really important. But when you have a trusted financial advisor who's and they know you, and something happens in life. Chris, you mentioned the term "what if" a lot. So just a few things that have happened recently to clients is, they come and they say, I'd like to give a gift. I'd like to give a gift to a child or a grandchild. And, their heart is pushing them towards this gift, right?
Yep.
But in the context of what they also plan to do with some of that money, meaning live a comfortable life of retirement, how does that gift, which is wonderful if you can do it, if you can afford to do it, we want you to do it. But how does that gift impact
Your
the rest
security.
of your financial plan, right?
Yeah.
So by having the ability to have someone that you work with to just call them up and say, hey, can I come in, have a cup of coffee with you and give you a what if I give this gift to this charity, my child, my grandchild, whatever it is, or buy a second home, right? Or go on this big vacation or buy this luxury car. And how does it fit into the rest of everything we planned out? That, although it doesn't really enhance their return, meaning how much money did I make this year? That is in some ways more important of having a trusted financial advisor than, geez, what mutual fund am I in? What stock do I own? What's my bond portfolio doing? Because those what ifs, if they're not done right, either you'll be too generous, you'll spend too much, and you'll be 85 years old and not living the way you want. Or the other side is, I have a client that I've talked to recently who has plenty of assets, but she needs to get the mindset that she can afford to live comfortably because she's lived frugally so long. So
Yeah.
having that back and forth and giving them the assurances and showing them the projections and just giving them the almost permission.
Yeah, you're right, Jeff. That's so true. There are so often that, it's finding this balance. Like, we don't want to use up too much too soon, but we don't necessarily want to live so meagerly that we miss out on opportunities of how we could have a more fulfilling retirement, And you're right. Oftentimes when those situations occur, it is a matter of just saying, look, see how it works.
Yeah.
You have permission. You can, it's good. Maybe you should go do these things while you can,
Or don't.
Yeah. And then in other times, like you said about the parent, we've run into that countless times where parents love their kids. They want to help them out. They oftentimes do it at their own detriment.
Right.
And we've had a number of occasions where, despite our best advice, people have gone down a path and found that led to them being more financially challenged, maybe even running out of money.
Right.
And so it is really important that people do have that opportunity for counsel and input. And I think you're right. The value that can provide can be even greater than, are we getting a better rate of return than they might have gotten, or are we taking a little less risk than they might have otherwise had, or whatever it might be as it relates to the portfolio. It's a combination of things. So, listen, I'm going to use this as an opportunity this was a great conversation about, this question of, is there value in having a financial advisor? We, obviously, and we're biased. We think there is because it's what we do, and we hope we add value to people's lives, and not just their monetary sense, but also helping them to have a better quality of life because they are freed up from these kinds of concerns, and they have less stress, and they have a better sense of what their abilities are, and they can go off to do the things they want to do. So in any case, let's extend that offer again. The beginning of the year is a time when most people give some thought to, new beginnings and resolutions. Maybe it's about their health or their weight, or oftentimes it is about their finances. Mm-hmm. And as a consequence of that, we at AMR have gotten into the habit of offering complimentary portfolio review service that we're giving away at this time of year. So if you would benefit from having a second set of eyes to review your financial planning and portfolio management situation, take advantage of this. Essentially, it's a 2-meeting process. We meet with you. We send you out a packet for schedule a meeting. We meet with, and by the way, we've just started this early in the year. We're still not booking as far out. We've gotten some responses, but it's a good time to get in because by a couple of weeks from now, we'll be booking out much farther out, so it'll be a little harder to get in quickly. But in any case, we offer a 2-meeting process. The first meeting, roughly an hour, maybe a little longer. We gather all your data that you've put together, and we talk to you a little bit about what's going on, what's working, what's not working, what's your impressions, what are your concerns, what are you looking to address. We want to understand what's happening in your life, cash flows as well as portfolio kind of thing. And then we take that information, we step back, we do some analysis, we put together some information in our programming to help sort of get a forecast of how things project. And then we put together a presentation, a PowerPoint that's going to say, hey, here's a little bit of information about us, but here's what we found. And these are some things you might want to consider, some observations, some recommendations. And then it's up to you whether you find this to be of value, go ahead and implement some of these ideas on your own, or whether you decide, hey, this might be the place for me. If I'm looking for who could be the right fit for our needs. We hope you'll consider that. In any case, if you want to take advantage of that, it's a complimentary portfolio review. Reach out to us at amrfinancial.com, which is our website. You can reach out, and on the website, there's a on the first page, there's a banner that's going across the screen that mentions the complimentary review. But you can also go to, where was it on the?
It's on our homepage.
Yeah, right on the homepage. And then alternatively, you can send us an email, radio@amrfinancial.com. Just in the subject line, mention the offer or the complimentary review. And tell us how to reach you so we can send you the packet and schedule that meeting. You can also reach us by text, 508-915-3700, 915-3700, pretty easy. Or, of course, you can give us a call, 508-771-8900, toll free, 866-771-8901.
Can I just say one last thing about it, Chris?
Yes.
It is an opportunity. It is not an obligation. There's nothing you need to sign.
That's right.
We hope you'll walk away with some good financial information that you haven't considered before. And of course, we'd love the opportunity to support your business or to support your financial needs, but there is absolutely no obligation with this offer.
Absolutely. So great opportunity. We hope people take advantage of it, and we think in the process there'll be a good fit for some people to get some good nuggets out of it, and hopefully start the year off on the right foot. We're going to take a break. When we come back, we'll talk a little bit more about markets right after this. Stay with us. Welcome back to Something More with Chris Boyd. We've got a same cast of characters here. Kathy Ingersoll, our marketing director, Jeff Perry, and now we're joined by Brian Regan, our firm's chief investment officer. And we wanted to talk a little bit about, and of course I'm Chris Boyd. Probably should say that once in a while. And we're going to talk a little bit about geopolitical issues and impact. It's something we've been, Jeff, you and I have been talking about this over the last month or so, that this could be things that will have be on people's minds. It seems to be on people's minds quite a bit over the last year, really. And this is part of the the investment landscape as we think
both,
about
right?
Yeah, a little bit of that too.
Yes.
But and so maybe we can kind of lay out what are the kind of concerns that people are having. And Kathy, I know you have some observations you want to chime in too, but Jeff, why don't you get us started? Just sort of what are the kind of things that you hear about from investors and the kind of concerns they have?
Sure. Well, we started the show by talking about the returns for 22. And some of the concerns certainly people have are political in nature, and maybe they're not exactly relevant to what we should think about for the portfolio. But sometimes there's trends or situations developing across the world that do affect our markets and do affect our companies. And, we've been almost a year now, right? Coming up on a year, not too long from now, but that Russia's invasion of Ukraine has been not only devastating the country and harming and killing the people, but is having some still impact on energy prices and availability of fertilizers and all of those things. And I think what got our conversation going, Chris, was specifically talking about China after President Xi was, I won't say reelected because that's really not when he started this new term or this new phase of his tenure, is leading China. And he made some pretty aggressive statements about unification plans with Taiwan. And we saw how the zero COVID policy shut down China for a while. It seems to be opening up. And now we're seeing tensions with Chinese planes, invading U.S. Well, I'm biased here, but invading
international waters kind of thing,
right?
Claiming them to be, this has been going on for years, really, right?
Right. But it all seems to be culminating a little bit. And maybe I'm more sensitive to it. I wanted to ask Brian these questions on the air. We've seen the U.S. government takes significant steps with the CHIP Act last year to bring some chip, meaning semiconductors, manufacturing to the United States. And companies like Tesla and Apple, who do and have done a lot of manufacturing and business in China, are now stepping away. So I know I'm saying a lot without saying anything, but so these are things that are in the financial news headlines, right? And are on the CNN and Fox's and impacts psychology of investors who worry a lot. Like,
we've definitely had investors ask about these things
Absolutely.
and say, "Hey, I think this is going to bubble up and this is going to be problematic for investment. How should I react? That kind of question."
At the same time, you have, it's prudent. Kathy was just leading us in a conversation about diversification in the last segment and made some great examples. But typically, when you're talking about diversification, you'd like to have some international equity exposure if you're a stock investor. So how does that fit into these fears, or are they opportunities?
And to that point, Jeff, most U.S. investors, including our clientele, are underweight foreign exposure, which, if it is an opportunity, that's something that needs, review and consideration. But we've benefited by being underweight non-U.S. stocks over the past many years.
And Brian made a great tactical move before the Russia invasion,
right,
to limit the exposure there, and some moves related to China last year. We can, this is in the past now; it's kind of forgotten about, but there were some steps making to minimize that. So I guess I wanted to ask Brian, in a very long introduction to a question, what do you think, Brian?
Yeah, there you go.
What do I think about the world?
Yeah.
Well, I think I generally agree with everybody and everything that's being said. There's a lot of things to worry about, right? I guess some things to keep in mind is a lot of this stuff has already been in the past, right? Not necessarily the China-Taiwan thing, but the China-Taiwan issue has been an issue since 1949, when the Communist Party won the Civil War and pushed the Republic of China, what was remaining of the Republican Party of China to Taiwan. So that's not a new issue. It's 83 years old or 73 years old. Sorry. But certainly, it's still an ongoing issue. The Chinese Party hasn't forgotten about it. They still consider Taiwan as part of mainland China, and it's their stated goal to reunify, in their words, the country. So I think, that's definitely a concern, especially considering the biggest semiconductor manufacturer in the world by a large margin is Taiwan Semiconductor, primarily located in Taiwan. So we've seen the United States respond to this pretty aggressively in the last year. Most notably, I think you mentioned the CHIPS Act to try to offset some of that national security concerns with the biggest manufacturer being in Taiwan. The CHIPS Act basically gave incentives for companies to onshore the manufacturing of their semiconductors. We've also limited Chinese access to some of the more advanced semiconductors that are designed in the United States. So, that has obvious impacts on the semiconductor market, for example, and the companies, that are United States based, that are domained in the United States. When it comes to Europe, I think it's been an overwhelmingly interesting year talking about what's happened in Russia and Ukraine. Devastating as it has been, it's also been, I think there's some things to cheer. We throughout the year, we were very, very, very concerned about what Europe was going to do for their energy needs. Were they going to be able to replace the LNG, the natural gas that was coming from a pipeline in Russia with LNG from the United States? And if they couldn't do that, could they continue to operate their economy? These were real concerns. And you saw that reflected definitely in the first part of the first half of the year, in the international, especially the European stock markets and bond markets. And then don't forget, we had in the UK, we had a turnover of the British government 3 times.
Right.
Boris Johnson was the prime minister, then Liz Truss was the prime minister for 44 days. And now they have a new prime minister, and forgive me, I don't remember his name off the top of my head, but Liz Truss's reign was very problematic for both the bond and stock markets.
Right.
So all this kind of culminated in a very rough, 9 months of 2022, and then not to mention, just to add on to those bad things before I go on to what happened in the last 3 months. China basically squashed their whole market. They have a giant debt problem that still exists in the property sector, which is one of the largest parts of the economy. And then they decided to start to crack down for unbeknownst reasons on their tech sector. Basically, I think they just thought that people were getting too rich off of it. They wanted to gain back some control. And then on top of that, the zero COVID policy. Now, in the last half of the year, we've seen a lightening up on some of those tech sector issues that I mentioned, but more importantly, we've seen a loosening up of the zero COVID policy, and Chinese stocks have skyrocketed more recently, and actually led the international index higher than the S&P 500 for the year, interestingly enough. So, a lot of this is played out, right? I think for the most part, at least in 2022, the energy crisis in Europe has been averted. But as Kathy noted, that there are certainly still concerns with food. We actually saw oil round trip. We saw a huge spike with oil going to 120 and falling back down, actually below the pre-war levels. I think it's at 70. WTI is around 73 today. So a lot has happened. There's been a lot of turmoil. We saw the dollar skyrocket as the Federal Reserve started to raise rates faster relative to the rest of the world. And as the Federal Reserve starts to slow down, we're actually seeing a little bit of reversal there. So that might not seem like a big deal, but that puts a lot of pressure, particularly on third world countries' currencies and their debt, which puts pressure on emerging market equities as well. We're starting to see a bit of a reversal there, which is good to see, and maybe that's maybe a bright spot for 2023. So I just kind of rambled with a lot of issues. I think I took, your introduction, which was an ample one, and ran with it. I don't know if there's anything that I said that that you want to pull a string on, but let me know. I think this is all very interesting.
I think the global economy, it's been the last 50 years or something that we've been moving more and more to a global economy. And of course, the benefit of manufacturers having just-in-time inventory so they don't hold all those cost overhead. But it's all well and good when we play nice, right? When we play nice with our neighbors around the world. But when we have these geopolitical tensions, like you said, Brian, China's the largest exporter. They export phones. Probably all the phones that we're using have come from China, or many of them. So should U.S. companies start, I don't know, are we going to start seeing de-globalization starting to occur as a result of the tensions that we're now seeing? Will we see multinational companies start pulling back out of these overseas countries and start coming back to the U.S.? Like a lot of our customer service is outsourced to India. Will companies continue to go that route of finding cheaper resources in other countries at the risk of being able to provide services?
It's a good question. I think, and I think it's certainly debatable around the edges, but I still think there's just overwhelming evidence that globalization has been good for everybody, especially in countries, particularly like China or Vietnam or some of these emerging market countries where people have come out of, abject poverty to the middle class over the last, 40, 50 years, particularly after China entered the World Trade Organization. And it's also made, been good for Americans in the way that it's made a lot of the things that we buy and enjoy on every day a lot cheaper, whether it is, customer service or an actual product. Ultimately it
keeps costs down, and that's been a big part of why our inflation has been so low for a long time prior to this year, right? Or last year. I totally agree with your point. I don't think there's any question, though, we are seeing an element of, a directional change, a reverse in direction as it relates to globalization. And I think ultimately that, and Jeff, I'd be interested in your thoughts on this too, but I think ultimately that's, disadvantageous long-term for national security. Mm-hmm. When it comes to, which is different from what we're focused on in terms of portfolios, but in terms of policy that is good for America, having trade partners, aside from the virtues of the financial benefits, it tends to export our values, and it tends to create less willingness to engage in conflict if we are financially interacting. If our interests are aligned in that.
Yeah.
Agreed. If the United States and China, the two strongest military powers in the world, have mutual benefits and detriments to their relationship or not a relationship, the more equal it is, the more safe we are. If we want cheap goods and we rely on them, and that's to our benefit, and China can feed its people and keep their economy going by American dollars going into China, that's mutually beneficial. And that's, I think both countries and both leaders would agree with that. But sometimes, as we know, other things, such as this reunification policy of the president, the chairman of China, which is he's not dancing around it, right? So if that is his legacy and that is more important to him, now we're trying to be rational and think about what makes sense in a rational world and for everybody and for the people of China. We just don't know. I mean, it's like North Korea. What's their true motivation? What's China's true motivation with Taiwan? If it's Taiwan over everything else that is rational about trade and the relationship, then the United States has to be prepared to be able to take care of itself. And that's to your question, Kathy. I think that we are seeing companies already starting, not just the chip companies, but you're seeing companies look for alternatives, and they may not be in the United States. They may be in other parts of Asia. Nike, for example, has left a lot of China, and they're going into Vietnam and other countries where they can still get that type of.
But just diversify.
That's right.
Where they're. Yeah.
Right. So I think that's already happening. Whether or not it can happen at a pace that's in our national security interest, it takes a long time. It took a long time to get there and create the systems and supply chains that we have, and it's going to take a long time to diversify them. But I think it's already happening.
Well, and I think if you look at over the last, the last administration, there was this was part of the policy, renegotiate trade agreements, and just really a big move to really question free trade. That kind of thing.
Well, the definition of free trade is really up for debate itself, right? I mean, some of it, especially when you start to talk about tariffs and free trade, the argument is should be free for both sides, not government subsidized on one side. And
fair enough.
My question I wanted to ask, go back to Brian.
We probably should take a break.
Sure.
How about we come back with your question right after this? Stay with us.
Great.
I guess you're just what I needed. What I needed. I needed someone to feed. I guess you're just what I needed.
Welcome back. We're just in the midst of conversation before the need to take a break. Jeff, you were about to ask a question. Let's jump right back into it for our final segment, short segment we have here.
Great. I think this was a great discussion, and it's the discussion they're having in Congress and across the world and various governments. How does all this benefit us or them, right?
Yeah.
My question to Brian is how do you look at this as our chief investment officer, and how do all these things fit into the exposure and the types of international equities that, traditionally are part of a diversified equity portfolio?
Yeah, it's interesting, Jeff. It's a good question. I try to step back and ask myself, what do we know for sure and what is speculation? I think that China invading Taiwan right now is just speculation. I mean, it's not that it couldn't happen. It's that it hasn't happened in 73 years, and it's not like they haven't been trying to do it or planning to do it. It certainly could happen, but, I tend to believe that countries that trade together don't war together. And I think the United States and China both need each other very, very much, especially given China's economic and demographic problems right now. So I don't like to invest in China for a different reason, although that is a good one. The different reason is that you can't trust the assets. You don't really own the company as you would in the United States. I wrote an article about this about a year ago. I'm sure it's on our website if you want more detail on it, but that's generally why I don't want to hold Chinese assets. Now, I do think the fact that capitalism seems to have solved, at least in the short term, Europe's energy problem, and I think it'll only get better in the longer term. And how does that happen? Well, basically every energy storage in the world has been shipped over to Europe for the sake of higher prices, which has been great, right? We've been able to fill up their gas tanks. Luckily, there's been a less harsh winter so far, a less harsh autumn, and it seems like they're going to be able to continue to keep their economy running, albeit possibly even likely have a recession. But I think what you're seeing is the market kind of look through some of that. I think we've seen a bit of a rally here in international assets recently, and part of that is because of the United States slowing their pace of tightening, which is weakening the dollar, which makes international stocks relatively more attractive, but also this energy component. So I do think that there is a bit of an opportunity there in international stocks, especially as China reopens. It will tend to benefit companies like in Vietnam or South Korea or Malaysia or India as well. So or Australia, which is a big commodity producer, and China's a big commodity buyer. So I think given the end of the China zero COVID policy, the decline in the dollar, it makes international assets much more interesting right now. I think generally speaking, I would prefer to buy international debt right now rather than international stocks. And the reason for that is because they tend to be very, very highly correlated during non-panic times with the 10-year Treasury, or negatively correlated. So if you believe that the inflation is going to come down in the United States and the 10-year Treasury will follow, I think you're getting a yield to maturity over 7% on those international assets right now. You could extend some duration, be highly correlated with a U.S. asset, and get paid significantly more. So I think when it comes to international assets, that's where I'm more focused right now.
Well, that raises a topic that we won't get to today, but
it does, yeah.
Jeff had mentioned off air in a break that he was hoping we'd get a chance to talk about fixed income investing and a change in outlook as you look at from one year to the next in terms of why we might want to think about bond investing. So Jeff will definitely tackle that in a future week.
It's a good tease for next week.
Yeah, I think so. Brian, that's some great stuff. And I know for our clients, you're working on putting together a webinar that will be laying out sort of our outlook for the year and, kind of make sense of what happened last year and how that might apply to thinking about our portfolio construction and any adjustments we might be making in the year ahead. So for our clients, we have that coming up on the 18th, I think it is. Yeah. Correct. And we'll certainly be sharing some of those themes and thoughts the following week on the show. So I'm sure that'll be coming up soon. In the meantime, I just want to, as we kind of wind down the show again, you all have been great in sharing some thoughts with our listeners about why it is that having the right people involved in your financial team, we as individuals, we create a team around us, whether it's our lawyers, our accountants, and our financial advisors, maybe insurance and a bunch of other things. It's important to find the right people that fit your needs. And to help in that effort, we're offering a complimentary portfolio review. You'll be hearing about it over the next week or two, couple of weeks, maybe longer than that. But we've got this opportunity that we're providing to our listeners because this is the time of year when people think about their financial life, and we want to give you the opportunity to benefit from a second set of eyes. We deal with this day in, day out. Our expertise is primarily in dealing with people who are in or near retirement, but candidly, we work with people at all different stages of life, and we may be able to be of help to you in thinking about your financial planning and portfolio management. Take advantage of this offer. It's a complimentary portfolio review. It's a 2-meeting process. We do meet with everyone to gather information, get a sense of their situation. We plan for about an hour or so in each meeting. That's not unusual for it to go a little longer. But in any case, we like to get a sense of your needs, your situation, what's a concern to you that we can maybe try to help you resolve. We dissect what's going on. We do some analysis. We put some plans together where we forecast a little bit how's this play out over time, and then make some observations about how you might be able to make some changes if you want to, if it's needed. It's not always needed also, so anyway, give you some observations, some recommendations, and you can take that with you and make the most of it for however it helps you. If you're interested in taking advantage of this, please reach out to us through our website, amrfinancial.com. Send us an email, radio@amrfinancial.com. Mention the offer or the portfolio review. And you can also text us, 508-915-3700. Other than that, you're always welcome to give us a call, 508-771-8900 or 866-771-8901. That's all the time we have for the show today. Thanks all for being here. Great team effort today. I really appreciate all the input. Some interesting conversations. Hey, one show of the new year down. Until next week, keep striving for something more.
I'd be rich.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.